Hey, it's John from stopsaving.com, and welcome to the next video in our course, Technical Analysis Simplified. In this video, we're going to pull together what we've already learned about W-bottom patterns and what we learned about Bollinger Bands in the last video, and learn how to trade W-bottom patterns with the help of Bollinger Bands. This is a powerful strategy for spotting potential bottoms in the price, so without further ado, let's jump in. So here's what you'll learn in this video. Number 1, how to use Bollinger Bands to confirm true W-bottom patterns. 2, how to use the Bollinger Band percent indicator and Bollinger Band width indicator to help you trade W-bottom patterns. And finally, number 3, how to manage risk when trading W-bottoms. So by now you're probably asking yourself, why do Bollinger Bands help with trading patterns like W patterns? Well, let's recap what Bollinger Bands do from the last video. Remember, Bollinger Bands can tell you 1, how volatile an asset is at any point in time, 2, if volatility is going up or down, 3, if the trend is getting stronger or weaker, 4, if an asset is overbought or oversold, and 5, if there's extreme price movement. Now, this is all very useful information if you're trying to decide whether the price has formed a low or not, and you can overlay W patterns on top of Bollinger Bands to get a better idea of what's going on between buy and sell pressure when a potential low is forming. This can give you a better framework to trade W patterns. So let's now look at a W bottom with Bollinger Bands in action. Here's the 1-week chart of the US dollar index, or DXY, making a major low in late 2021, early 2022. Now, the low took a long time to form, but if you were using W patterns and Bollinger Bands, you'd have seen it happening step by step in slow motion. Here's the first low. Notice how the price closes below the bottom band. In other words, it was relatively far away from the middle band. The bands were also quite wide apart on this low. This signaled that there was a lot of volatility in the price and a lot of fear among investors. Let's now compare this with the second low, low number 2. This low closed above the bottom band and closer to the middle band than the first low. Now, if you were to compare the two lows without Bollinger Bands, the second low doesn't really look like a higher low. It bottomed pretty much at the same price point as the first low. But with Bollinger Bands, it's actually a relatively higher low. See, the second low is a lot closer to the middle band than the first. It's also further above the bottom band than the first. In other words, the second low is closer to the 20-week moving average than the first, making it a higher low versus the 20-week moving average. Understanding this point can be a huge advantage to traders. Most would agree that a higher low is a good sign that a downtrend is reversing into an uptrend. But with Bollinger Bands, the second low could actually be lower than the first, but still a relatively higher low in terms of the Bollinger Bands. The next thing to notice about the second low is that the Bollinger Bands were narrower at this point. That means the second low happened with lower volatility than the first. This is a good sign that there's less fear among investors as the second low forms, and that suggests that the price is gradually finding a base from which to trend higher. In the final section of this course, I'll show you how to set up different indicators in TradingView, and here are 2 I really like to use. There's the Bollinger Band width indicator in green, which we covered in the last video. This represents the width of the Bollinger Bands. The higher the reading, the wider the bands, and the higher the volatility. Then at the bottom we have the Bollinger Band percent B indicator in orange. This represents where the price is positioned relative to the Bollinger Bands. When it goes up, it means the price is getting closer to the top band or even above the top band at extremes. When the indicator goes down, it means the price is getting closer to the bottom band or below it at extremes. So let's now look at the same DXY chart from the last slide, but this time referencing these two indicators to show what's going on. There's the first low, and there's the second low. Remember, with Bollinger Bands and W bottoms, you typically want low 2 to be a relatively higher low than the first, compared to its distance from the middle band, and you also want low 2 to have lower volatility than low 1. And that's exactly what we see in this case with the DXY. The green Bollinger Band width indicator has gone down, meaning volatility is lower on the second low, and the orange Bollinger Band percent indicator has gone up, meaning that the second low is a relatively higher low in terms of its position relative to the Bollinger Bands. Now, as promised, here's the strategy for trading W bottom patterns. First, you buy when it looks like the second low is starting to form. Your criteria for this can be more aggressive or conservative, but here I can see a few indecision candles around the second low, followed by a slightly stronger green candle. Buying after that candle closed would have been a pretty good entry point in my books. Feel free to refer back to video 2.1 on candles and line charts, as this will be useful in helping you decide if a second low looks to be forming or not when trading Bollinger Bands. And as for risk management, I'd set my stop loss under the spike low of the second low. Sometimes W patterns can turn into bearish descending triangles, so you'll want to get out of your trade if that happens. A stop loss will automatically sell your position if it gets hit. While that can result in a small loss, it's better to be safe than sorry in my experience, as a small loss now is usually better than a potential big loss later on if the price keeps going lower. As for when to take profits, that depends on your trading style and risk tolerance. Swing traders will want to stay in the trade until it looks like an M top is forming, and we'll cover that a bit more in the next video. And range traders might want to take some profits near the top of the W. Another option is to take some chips off the table once the price reaches the top Bollinger Band, and then let the rest run until some kind of topping pattern is formed. So let's now switch to the Nasdaq 1 week chart, and here's an example of how you could get an earlier buy entry with Bollinger Bands than without Bollinger Bands. Here's the W pattern. There's low 1 and low 2. As you can see, low 2 was on lower volatility than low 1, which is just what we want to see. And low 2 was also a higher low relative to its position on the Bollinger Bands, another check mark for the buyers. You then buy after this green weekly candle closes, and set your stop loss under the wick of the second low. Now, if you were looking at this chart without Bollinger Bands, low 2 would have looked like a lower low than low 1. And any sensible trader will tell you that the price is still in a downtrend, so it's better to wait until it makes a higher low before buying the index. Well, that higher low did happen here with another W pattern. But if you were using Bollinger Bands, you might have started buying earlier or averaging in to build a bigger position before the eventual liftoff of the index. So let's now look at another example with Bitcoin on the one-day charts. There's a W pattern, with the second low on slightly lower volatility. It was also a relatively higher low in terms of its position on the Bollinger Bands. So the strategy would be to buy when it looks like the second low is forming, like after this green candle, and then set your stop loss under the wick low of the second low. Now, anyone who's been in crypto for a while will know that Bitcoin is notorious for laying traps for traders, often before its biggest run-ups in price. But by using Bollinger Bands here, you'd have been a lot less likely to get shaken out of Bitcoin so you could stay in your trade for most of the 2020-2021 bull market. So here's another example of a very slow W pattern that formed after a big flush down in the price. Lower volatility, higher low relative to the Bollinger Bands, buy once the second low looks to be forming, and set your stop loss under the last low. Here's a table to drive the concept of Bollinger Bands and W patterns home, comparing the first and second low in terms of its band positioning and volatility. The first low is lower than the second in terms of its band positioning. It can be below the bottom band or further down from the middle band, which again is the 20-period simple moving average. We also usually want to see the first low happen on higher volatility than the second. It's a more extreme, more fearful, and more volatile drop. And now for the second low, we want to see this to be higher than the first low in terms of its band positioning. This low can be above the bottom band or closer to the middle band, which is the 20-period SMA. That would make it a relatively higher low compared to the 20 SMA, even though the price might actually be lower than the first low. And as for volatility, you'll typically want to see the second low have lower volatility than the first. This shows that buy pressure has slowed down and fears have subsided. Of course, W bottom patterns don't always have to work out like this, and that's where stop losses and risk management come in. So here are the key takeaways of this video. Number 1, Bollinger Bands can help you find better W bottom trades. 2, typically you'll want the first low on higher volatility with wider bands than the second low, i.e. more fear than the first low. 3, you'll also want the second low to be a relatively higher low versus its distance from the middle band. It doesn't actually matter if the second low looks lower on the chart. 4, use the Bollinger Band width indicator to compare the volatility of the first low and the second low. 5, use the Bollinger Band %B indicator to compare the distance of each low from the middle band. 6, you can buy when the second low looks to be forming. Set your stop loss below the wick of the second low. And finally, number 7, take some profits when the price reaches the top band if you prefer. Of course, this will depend on your trading style. So that's it for W patterns and Bollinger Bands. Within this framework, you should have a good strategy of when to buy into an investment. Next up, we'll look at when to sell with M topping patterns and Bollinger Bands. So thanks for watching, and I'll see you in the next video.